Good afternoon, ladies, gentlemen, and distinguished guests. And thank you to SKK Migas and the organisers of today's conference for inviting Wood Mackenzie and myself to present at this prestigious event. It's a great opportunity to speak with you and share our perspectives on Indonesia's place in the current upstream oil and gas sector. If we could just pull up the first slide for my presentation. The energy transition is transforming the upstream industry. For decades, we have become accustomed to oil and gas demand continuing to rise steadily on an annual basis. But now, with the energy transition taking hold, the future of oil and gas demand is more uncertain than ever. Now, how this plays out ultimately will be decided by the pace of this transition. Wood Mackenzie's base case forecast shows continued oil demand growth out until 2040, with demand likely to stay above 90 million barrels per day out to 2050. Now, meeting this demand will require investment in higher cost sources of supply, which should maintain oil prices above $80 a barrel until at least 2030. However, if we look at a scenario where we are able to limit global warming by 2 degrees, in line with the Paris Accord and recent discussions at COP26 in Glasgow, we see a very different outlook for oil and gas demand. Under our Accelerated Energy Transition 2 scenario, or AET2 for short, the energy transition happens much faster, resulting in significant demand disruption on oil. On the other hand, under both the base case and the AET2 scenario, gas demand remains much more resilient. In Asia, gas demand will remain especially robust given developing economies, the displacement of coal, and declining regional supply. Now, what these scenarios show is that there's a huge uncertainty in the oil and gas outlook, making long-term upstream investments very difficult to plan. And this uncertainty is expected to increase as governments enact new decarbonisation targets, as new technologies evolve, holder ESG scrutiny increases. So, what are investors and stakeholders looking for from the upstream sector? If we move on to the next slide. Oil and gas investors are increasingly focusing on resilience and sustainability. To remain investable and to attract investors, oil and gas companies need to build portfolios with resilience and sustainability in mind. And what do we mean by resilience and sustainability? Well, resilience is about the near term. Investors want companies that are positioned to handle fluctuating prices and with a diverse portfolio that can manage the ups and downs of the price environment. These companies must be strong financially, with manageable levels of debt, with steady cash flows, and with high margins. Flexibility to pause or cut spending if required is also a key factor. Now, turning to sustainability, this is more about the long term. And here, investors are looking for companies that are positioning for the energy transition. How exposed are they to carbon emissions or potential carbon charges? Are they invested in lower carbon resource streams? And is there a strategy to diversify away from oil and gas in the long term? Now, as a result, companies are building these metrics and indicators into their investment criteria in an effort to allocate capital to the most resilient and the most sustainable opportunities. Those jurisdictions that cannot support resilient and sustainable portfolios will struggle to attract investment. My next slide looks at how this longer-term focus on sustainability is impacting how the industry is allocating capital. So after several years of fluctuating prices, a focus on efficiencies and capital discipline has meant the industry, the upstream industry, is now leaner and fitter than it has ever been. which means if current prices continue at current levels, the industry is looking at a huge cash flow windfall over the coming decade. May seem like good news, but that cash flow windfall won't necessarily be allocated to new upstream investment. Here, we are showing the cash flow outlook for the 40 largest international oil and gas companies in our corporate coverage at initially a $50 long-term oil price. We're also showing our current forecast prices and the same cash flow outlook. And what's clear is that these companies will generate a lot of cash, even at $50 a barrel. And at current forecast prices, the largest operators are set to generate nearly $5 trillion in cash flow over the next decade. However, with financial strength a major focus in the pursuit of resilience, around 40% of these cash flows will actually be allocated to shareholder distributions and the repayment of debt. And as operators target more sustainable opportunities, the level of capital allocated to low carbon investments will account for around 20% of this cash flow windfall. So at current prices, investment in oil and gas will continue, but we don't expect it to ramp up investment with higher prices. The additional cash flow windfall that companies will be generating will be allocated elsewhere. The current prices provide really a golden opportunity for companies to strengthen financially and to accelerate investment into more sustainable low carbon opportunities. But competition for upstream investment is going to remain very fierce, very strong. If we look next at where upstream capital is being allocated, it's the usual suspects. OPEC supply, US tight oil will continue to fight it out for who can supply the most. The US will remain the #1 destination for investment over the next 5 years, even as US players continue to operate within their means and exhibit capital discipline. Deep water will continue as a key resource theme for the majors as economies of scale help with volume, value, and lower emissions intensity. And LNG will also attract investment given the longer-term resilience of gas demand and the relatively lower emissions footprint of gas for power over coal or oil. Interestingly, some regions, perhaps not considered as geologically attractive as others, are continuing to attract investment. The UK is one of the most fiscally attractive upstream regions and has been successful in maintaining investment in recent years. However, in the wake of COP26, public perception of the UK's remaining resources is changing. And so for how long will UK operators be assured of the current fiscal terms? The top 15 destinations for upstream investment shown here will in fact attract 3/4 of the upstream development spend over the next 5 years. Wood Mackenzie estimates around $400 billion per year is needed to meet our base case demand projections. So that means the rest of the world's upstream regions or countries are competing for around $100 billion per annum. And as Bapak Dwi showed earlier, Indonesia is targeting around about $18 billion a year in upstream investment. The country is going to have to work really hard to attract its share of remaining upstream investment. Now, looking to the next slide, to compete for that upstream capital, governments around the world are continually enhancing their fiscal terms. The text is a little bit difficult to see on this slide, but essentially what we're showing here is just how many countries are currently in discussions or have recently implemented fiscal change. And as maybe you can make out, the majority of these changes are amendments that will make the terms more attractive for investors. So working harder to attract investment. Now, it's important to emphasize that fiscal terms are continually evolving. And so it's important to keep them under review to remain competitive. Those countries that stand still will soon fall behind. And if we look at the next slide quickly, more and more of these changes will include new policies around emissions and decarbonisation. And this is going to be a key focus for countries in the coming years as governments work towards their declared climate targets. Now on the next slide, I want to just highlight that governments are facing some really tough choices in the wake of COP26 and as they work to some of those agreements or commitments that they made as part of the Paris Agreement. You know, striking a balance between meeting energy needs, maximizing the value of natural resources, and also meeting net zero ambitions. These are all competing priorities, very difficult to balance. And we see three potential pathways that governments could choose to answer these difficult choices. Firstly, they may choose to simply harvest the remaining value of their oil and gas resource for as long as possible, maximizing government share by increasing taxes and NOC equity. But this would require major sources of domestic capital to replace international investment that would surely be turned away by this sort of focus on domestic revenues. Secondly, governments may choose to recognise that oil and gas demand will continue for decades, and incentivising new upstream investment at all costs. This could grow the industry, but would also put environmental targets at risk. The third approach, and perhaps a more sort of hybrid or collaborative approach, would be a more transitional approach, which would see stimulus to maintain but decarbonize upstream operations while encouraging the development of renewables and other low carbon sources of energy. This approach would recognize the importance of oil and gas and its ability to fund the transition, and it would allow for a more gradual transition, but it would require significant collaboration across the energy sector, across different government bodies, and it would require very strong and determined long-term planning. On the next slide, we highlight how important and perhaps challenging this third approach could be for Indonesia. So here we're really asking the question, how can Indonesia meet both its 1 million barrel a day and 12 million cubic feet per day production targets, whilst also progressing towards its nationally determined contributions to emissions reduction? Well, on the left-hand side, we are showing, based on Wood Mackenzie's data, that emissions, upstream emissions in Indonesia will fall over the next 15 years. However, this is a natural consequence of production declining over the same period. In actual fact, as Indonesia boosts future production through the redevelopment of mature fields and enhanced recovery investments, we actually forecast Indonesia's emission intensity to rise. And so to de-link emissions intensity and production, significant investment will be required in CCS, CCUS, and other solutions to decarbonize upstream. International investors such as BP, and we've heard of BP committing earlier today, Repsol, ExxonMobil, alongside Pertamina, have stated their willingness to invest in decarbonization, with a particular focus on CCS and CCUS. But these investments need to compete within their global portfolio, and they need to be not just sustainable, but also financially resilient. And it's not just decarbonization that will require support. More investment will be required if Indonesia is to meet its production targets. Oil and gas remains a key part of Indonesia's energy mix through to 2050. And Indonesia's oil and gas demand, forecast to rise by 50% by 2030 and could treble by 2050. There's a lot of oil and gas that needs to be produced to meet that demand. The next slide looks at how challenging it might be to attract that investment. When we benchmark Indonesia's upstream fiscal terms, in terms of fiscal attractiveness, we find that Indonesia has improved its ranking in recent times. And we've heard from Bapak Handoko on some of the more recent changes that have been implemented. But when we look at Indonesia on a global context, it still remains below those countries that are attracting the bulk of upstream investment that I've highlighted earlier. Now, fiscal attractiveness is a function of how challenging or otherwise a country's fiscal terms are for investors with respect to the investor's share of value, bonuses payable to the government, and the level of carried equity for the state. And investors, when they're looking at fiscal attractiveness, they also look at other factors such as prospectivity, the cost environment, or regulatory stability. So it's a fine balancing act. Now, the chart shows that Indonesia's fiscal terms are more attractive than, for example, Iraq or Brazil. However, Indonesia cannot match those countries for resource potential. Typically, the countries with the best prospectivity can set their terms tough and still attract investment. But those with lower prospectivity or more challenging business environment need to make it easier to do business to make up for their other challenges elsewhere. And this is perhaps better illustrated on the next slide, where we combine fiscal attractiveness with that geological prospectivity. Now, each of the blue dots on this chart represent a country or oil and gas fiscal regime, and we've plotted them in terms of how we rank them. The higher up the chart the country is, the greater its resource potential. The further to the right of the chart it is, the more attractive its fiscal terms are for investment. So the top right-hand corner is really where countries want to be if they're to remain competitive for upstream investment. What this chart highlights is that the majority of those regions that are attracting the largest share of upstream investment have a real winning combination of prospectivity and fiscal attractiveness. Those in the top right quadrant are most favoured by international investors. Indonesia, from a geological perspective, could be compared with the likes of Malaysia, Australia, and even the UK. However, those countries have much more attractive fiscal terms and are therefore more likely to attract investment. The dotted line on the chart here represents the average trend of prospectivity versus attractiveness. So Indonesia sits just on that line or just above that line. So despite these recent enhancements, Indonesia's ranking in this chart is good. But is it good enough? To conclude, my final slide, incentivizing upstream investment while pursuing the energy transition is a real tough balancing act. The energy transition is creating huge uncertainty for investors, for corporate strategy, and for energy policymakers. And what we see is corporate strategies changing to focus on financial resilience and environmental sustainability as stakeholder expectations intensify. Now, despite current high commodity prices, competition for upstream investment is higher than it has ever been, and we think it will continue to get even tougher. Ever increasing levels of investment will be required if Indonesia is to meet its dual targets of higher production and lower emissions. And we think incentives for CCS, CCUS are really critical to those targets. Now, Indonesia still requires major fiscal enhancements if it is to compete globally for upstream investment. There's been some great progress made in perhaps the last few years, but really, given those 2030 targets, we think that the window for more action is starting to close. Thank you very much.
Thank you.